just kind of go over some recent tax changes, some not so recent tax changes that affect you guys individually and sort of the real estate market as a whole. There's been a lot of changes, so I'm not going to go over everything, but just kind of things that are applicable here. And then we'll continue the presentation. So going back a few years to the Tax Cuts and Jobs Act, just a reminder that entertainment is no longer deductible. It used to commonly be said meals and entertainment. We kind of use the words interchangeably. Entertainment is no longer deductible. It doesn't mean you should stop doing it, by all means. If going out to the golf course or taking people to Patriots games or whatever you do is drumming up business for you, I would encourage you to keep doing that. Just know that there's no tax write-off for it, okay? And also, if you're somebody who's doing your own taxes, there is also, I've seen people miss this, there's what's called a qualified business income deduction, part of that new tax act, where 20% of the income that you guys make as self-employed individuals, you get to deduct from your taxes. So just a reminder on those. Now at the end of 2019, at the very end in December, there were some extenders passed, some provisions that had expired previously in 2017 that they brought back. And some of the ones that are applicable to this industry is the cancellation of debt for the home mortgage. For a period of time after the financial crisis of 2008, if somebody had a mortgage that was forgiven, it was counted as income, so they had to pay tax on it, and then they came in and said, well, no, we want to take care of this. So basically said if your mortgage is forgiven, you don't have to include that in your income. That is now back and it actually went retroactive for, you may have some folks that make sense to go back, but my point being is, you may start to see some movement in the market because now folks that have mortgages that are in a foreclosure type situation, they may now move forward with those because they can have those mortgages forgiven and not have the income tax effects of that. Also, PMI, private mortgage insurance, is now tax deductible again. It had gone away for a few years, but now it's something that can be deducted again. And one other thing that may help your buyers, and this too for our mortgage folks in the room, part of this new bill they passed at the end of last year, there's now a penalty-free distribution from your IRA for childbirth. So from 1 year from the date of birth, you can withdraw $5,000 tax-free from certain retirement accounts. And if you're married, $10,000. Where this is important is often when people have that first child or second child, it's time for them to find a bigger home, right? So this gives an opportunity where perhaps they may not have the cash on hand, but they have some money in retirement that they want to use towards a down payment. It now gives mortgage folks a tool to be able to get another $5,000 or $10,000 out, and that can happen again up to a year after the child's birth. And there are some provisions where they can actually put that money back in penalty-free. So it gives gives some flexibility there for buyers. Also, the other important one, health insurance is always a good idea, but starting in 2019, it's no longer required. So therefore, if you're filing your taxes now and you didn't have health insurance last year, you'll no longer be penalized. You'll no longer pay an extra tax on that. So that's just a little bit of a update. And two, on the retirement front, for those in the room who may have been in a position where they have to start taking required minimum distributions from their retirement account, which used to be at age 70 and a half, they've now moved that up to the age of 72. But along with that too, if you continue to work, it used to be once you hit 70 and a half, you could no longer contribute to your IRAs. That's now gone. You can continue to work and you can contribute to your IRAs. There's no age restriction on that anymore. All right, so now I'm going to move to this presentation. It's called Smart from the Start. It's just accounting tips for realtors. Now, this was originally designed for new realtors, but what I found in giving this presentation is that even if you know some of this stuff, I'm going to give you some hints that might make either help preparing your taxes for 2019 a little easier or help documenting things for 2020 a little bit easier going forward. So again, because this is so dry and boring, the only way I can get you to pay attention is part of your presentation is left blank. So you have to listen to me in order to be able to fill in some of the key answers. So,
presentations were not distributed.
Oh, they were not. All right. Give me 1 second.
Anybody else? Yeah.
I'll give you a second to have those distributed. While they're being handed out, I will touch on a couple other common tax things that are specific to this industry. Most of you give out closing gifts. Just know that technically they're only deductible up to $25. Again, I'm not suggesting that you restrict your gifts to $25. Just know that that's the rule. You can give a gift of any amount, but the tax deduction is only $25. The other one that's really important, gets missed by this industry a lot, is generally meals are 50% deductible. However, open house expenses, if you have a catered meal or you bring cookies or a sandwich platter or anything, that's 100% deductible. So if you're just giving your accountant, say, receipts and, here's everything I spent at a restaurant or from the grocery store, it'd be in your best interest to separate those and say, here were the expenses associated with an open house, because those specific meals are 100% deductible. So if that's something you're doing, it's worth looking at that separately. Yes?
A question about your point earlier, that you're no longer cut off with your IRA contributions. You do it till you're 90, is that correct?
Yeah, till any age, correct.
Okay.
As long as you have earned income.
Okay, so then my question is, if it used to be that you were required to take a mandatory distribution?
Correct.
Is that?
So that's, yes, so the first part of what I mentioned is, it used to be once you hit age 70 and a half, two things happened. One is you could no longer contribute to the IRA, and two, you had to begin taking what's called RMDs, required minimum distributions. And Tom may speak on this a little bit more specifically. But what they did is there's a little bit of a change in the 70 and a half. If you become qualified, it's now up to age 72. The caveat is if you're already 70 and a half, like right now, and you've already been required to start taking your minimum distributions, you have to continue on that cycle. There's sort of a period of people who in the last year and a half made the cutoff that they can't stop taking their distributions and start again at 72. Does that answer your question?
Yeah, and there's no longer a mandatory distribution?
There is, but it's moved up. You have until age 72 before they require you to start taking it out.
Okay.
72 is the new age.
Yeah, 72 is the new age.
Okay, sorry.
Okay. All right, so our smart from the start accounting tips here. So the first one that catches new realtors by surprise often is what's called the self-employment tax. Now, when you work for somebody else, or you have, and you got a paycheck in the past, the self-employment tax is Medicare and Social Security. You would pay half of that, and your employer would pay half of that. And that would come out of your paycheck automatically. Well, when you work for yourself, you have to pay both sides of that, the employer and the employee side. And that alone is 15.3%. So that's the first blank there. So that's pretty significant. That's one that folks are often used to paying whatever their tax rate is, but they're surprised when they have to pay this additional 15%. And again, that's Social Security and Medicare tax. And my pro tip there is that the self-employment tax is calculated on your net income, so what you end up with in your pocket. It's not calculated on your gross commission income. So it is 15.3%, but that's after your business expenses. Another one there's some confusion about is making estimated tax payments. Again, when you used to get a paycheck every week or every 2 weeks when you get paid, money would come out of your check and it would go off to the state of Connecticut and it'd go off to the federal government on your behalf. And then what happens when you do your tax return at the end of the year, it's sort of a reconciliation process. Did you overpay? Did you underpay? And you sort of settle up with the government then. When you're self-employed, none of that is going to the government, so you're required to make estimated tax payments throughout the year. And those are required on April 15th, June 15th, September 15th, and then the final payment is actually made in January of the following year. So I recommend that folks do that. If you are going to owe more than $1,000, it's required, and you'll face penalties and interest if you don't. So it's always a good idea. Two, for cash flow purposes, it's good to kind of get the money out of your pocket so that you're not surprised with a big tax bill at the end of the year and then not having the cash to do it. So my tip there is to open a separate savings account and set a savings rate for yourself. So whether that's 15% of every commission check or 25 or whatever the number is that makes sense for you, just take that money and move it over into that savings account every time you get a commission check, and then those funds will be there when you have to make your quarterly payments. Yes, sir.
Something that's always struck me as a little odd on this is June 15th and September 15th, you're still in the quarter in which you're making your payments. Clearly, our industry is one where our income is, shall we say, lumpy, and not always predictable there. So we're actually being asked to estimate what our income will be for the last 2 weeks of the quarter.
So a couple things there, and I may have said this out of mistake. We call them quarterly tax payments because they're 4 times a year. They're not actually, to your point, they don't actually line up with a quarter, right? But it's worth explaining. You're supposed to break up your income in 25%, and they basically look back and they say, as of April 15th, did they pay in 25% of what they owed for the year? As of June 15th, did they pay 50%, and so on. However, to your point, there's the income for you folks is not even all the time, right? So you could be unfairly penalized because you had all of your income, say, in the second or third quarter when all your spring market closings started to happen, right? So there is a provision, there's a form when we do this for what we call uneven cash flow, right? So if you're somebody who we have this huge spike in the summer and then first quarter and maybe fourth quarter are slow, when we do the tax return, if we have those uneven cash flow, we fill that out so you're not unfairly penalized because you paid in everything you needed to, it's just you didn't do it in 4 equal payments, per se. Okay?
What's that form?
I don't know the number off the top of my head, but it's basically a form we fill out when we're trying to have a penalty waived or modified. So the A in the SMART is account for everything. So make sure you're accounting for all your income and expenses associated with the real estate business. It's not necessarily important at this point to know, to focus on is something tax deductible or not, but just keep track of everything. And then when you meet with your accountant, you can ask those questions about, is this tax deductible or is it not? And the best thing I can recommend there is set up a dedicated checking account and or credit card account that you use exclusively for the business. Now, I'm not suggesting that you go out and get a new credit card, but perhaps there's one you already have that you use. By doing this, at least you have one credit card and one bank account to go back to look at throughout the year. You know every transaction in those accounts are business related. The blank here, missing $100 a month, just $100 a month. So it could be a subscription to something that you had on one of these credit cards you had. It cost you $500 a year. So it's important, and I see this all the time because people use their personal bank account or the personal credit card or series of them, and they go through the highlighter at the end of the year and they're trying to find all their business expenses, and they miss stuff, and when you miss stuff, it costs you a lot of money. So it's worth setting up a dedicated checking account, and I get it, like sometimes you have a mortgage to pay, so even if you just deposit that commission check in there right now and 30 seconds later you transfer it to your personal checking, at least everything has run through that one account, and we can go back and take a look at that. And then the other misconception is receipts must be saved. A lot of people think their credit card statement or their bank statement is sufficient to stand up against the IRS, and it's not. So it's not acceptable to just use your credit card statement in the IRS's terms. So my pro tip there is take a picture of your receipt. If you guys know these thermal receipts, they last about 6 months and then they fade, and you'll never be able to read them when you need to or when the IRS asks for it. So just take a picture of them before they fade. And the final one is track your mileage. There's multiple ways of deducting auto expenses, but one of the largest expenses in this industry, because you guys are driving all over the place all the time, is the mileage expense. So the IRS says you're required to keep a log. Do people do it? I mean, paper log, I don't know. I haven't seen one, and I do a lot of tax returns, but you're required. If the IRS comes looking, they're gonna wanna see that. So the best tip here is to use an app. Use an app on your phone. That's the best way. There's a bunch of them out there right now, and They run in the background, and basically it's one of those, this was before my time, but you have these dating apps, swipe left, swipe right, if you like them or you don't, right? So it's the same thing with the mileage. If it's business, you swipe one way. If it's personal, you swipe the other way, and at the end of the year, it keeps a nice report for you. So the good news is, of all of these things here, there's actually an app for all of them. On the back side of your flyer, I don't have it on mine, but there's a QuickBooks Online app, QuickBooks Self-Employed, and it will do all these things for you. It helps you calculate your self-employment tax. It will give you a little running total of what your estimated quarterly tax payments should be. It can connect directly to your bank account and credit card and download your transactions to it. You can take a picture of your receipts with this app, and it actually attaches it to the transaction so you can keep it. And it has a mileage tracker built into it. And the really good part is, if you go to that link that's on there, it's only $5 a month. So you can get a mileage tracker, take pictures of your receipts, track your bank accounts, credit cards, estimated tax payments, all that stuff for $60 a year. So, yes, sir.
Is the QuickBooks Online conveniently linked up to QuickBooks Desktop?
No, it's two separate products.
Thought so.
So the direction the product is heading in is from desktop to online, because then you can use it on your phone or desktop, or it's agnostic. It can work on any device.